Welcome to our third mini lecture for Chapter 10, and today we're going to cover Learning Outcome 10-3, which is analyzing and recording bond liability transactions. Now, bonds are a type of long-term liability, and remember that long-term liabilities are debts or obligations that will come due more than 1 year into the future, and there's a variety of types, including long-term notes payable, deferred income tax, bonds payable, even mortgages would qualify under this category, but we're going to be focusing specifically on bonds. It says here governments and very large companies sometimes need to borrow more money than any single lender can provide. And remember, you've got options when you need money. You could sell stock, which is considered equity financing, and you could sell bonds. That's considered debt financing because you're taking on debt. You're borrowing the money. That's something that you would do if you could not get the money all from one source. So bonds are financial instruments that outline the future payments a company promises to make in exchange for receiving a sum of money now. Usually those future payments are that they're going to get their principal back at a future time, plus regular interest payments. From the company's perspective, the bond is a long-term liability, but from the bondholder's perspective, it's considered an investment. The reason is they're going to be getting semi-annual or annual interest payments, and they can also sell their bond just the way they sell their stock. There's a bond market. Okay, so there's three components. We've got the maturity date. That's the date that the bonds are due to be paid in full. The face value. That's the payment that needs to be made when the bond matures. We usually call that the principal. And then the stated interest rate. That's the interest rate that's stated on the face of the bond that's used to compute interest payments. Each interest payment is computed by multiplying the face value, or principal, times the stated interest rate, times the fraction of the year that the payment is made for if they're made semi-annually. In other words, P times R times T, the same formula that we've used in the past to calculate interest. Okay, so let me show you a picture of a bond. I'm going to pull out page 455 from the text, and I'm going to have to scroll down really closely here to get, to get the picture of our bond here. Here we go. And this is a bond that is issued by General Mills Corporation. It's for $1,000, and often bonds are issued in $1,000 increments. That's our face value. That's the amount we're going to be using as the P, or principal, part of our formula when we're calculating interest payments. The maturity date, the date that this bond becomes due, is December 31st, 2021, and there's our stated annual interest rate. So when we calculate interest payments, we'll be multiplying, for this bond, 1,000 times 6%, and if the payments are made annually, that would be the amount, 1,000 times 6%, or $60. If they're made semi-annually, you would then multiply by 6/12. Let's see how they're made. It says here that, it said for redemption, pay interest at the rate of 6% per annum. That means per year. So they're annual interest payments made in arrears, which means at the end of the year on December 31st of each year. Now, most bonds are set up in $1,000 increments, and they pay annual or semi-annual interest. And then when the maturity date arrives, the principal is paid back. But there are a variety of other types of bonds. We'll discuss those in a future lecture. And those types of bonds may mature in installments, and or they may add up to the face value, kind of like the savings bond that the United States government issues. Okay, so let's get back to our notes. Okay, so we left off with the stated interest rate. Okay, now just a little story about how bonds come to be. Because if this is a corporation, then the company cannot take action in issuing bonds without the permission of the stockholders. So they have to propose to the stockholders the project that they're going to be using the money for, and then the reason for the debt financing. They would also have to let them know the interest rate, the terms of the bond contract, sometimes called the indenture, all the details with regard to that bond issue. And they would propose these to the stockholders at a meeting, and then the stockholders would have the opportunity to vote as to whether the company should proceed. If the stockholders approve, then the company prepares a prospectus and sends that to the SEC for their approval. The SEC decides whether enough information is being provided to potential investors to make a decision about whether they want to buy that bond or not. The SEC does not certify that it's a good investment or bad investment. They're just making sure that potential investors have enough information to make a decision. Now, if it's approved by the SEC, then the company would either decide to sell the bonds on their own, or they would engage an investment firm to do that for them. Now, this is the difficulty with bonds. When you first make your proposal to the stockholders with the details of the bond, how much you're going to borrow, when the principal will become due, or the face value, the stated interest rate, when you first make that proposal, it may be several months before you finally receive approval by the SEC. And when you make that proposal, you have to estimate what you think the going interest rate will be, the market rate, when your bonds are finally issued or sold, because you don't want to pay too much interest. But if you offer interest that's too low, people won't want to buy your bonds. So the solution is we issue our bonds, or price our bonds, I should say, to give bondholders the market rate of interest. We adjust the price up or down to make sure everyone buying the bond on that day gets the market rate of interest regardless of what the stated interest says on the bond itself. Okay, so let's take a look at a few terms here. The issue price is the amount that the bond will sell for. That's the amount bondholders or investors are willing to pay on the issue date in exchange for the cash payments that the company is going to be making over the lifetime of the bond. The market rate of interest is the rate of interest that investors are demanding from bonds on that date, and the present value, that's a calculation that we use to calculate that interest or the issue price. Okay, so sometimes, because the market rate differs from the stated rate on the bond, the amount of bond interest that the bond is going to pay, we have to adjust that issue price. In our first example, the interest rates match. The bond rate, in our bond here, the bond interest rate is 9%, and the market rate are exactly the same. When that happens, the issue price will be equal to the bond's face value. The amount borrowed, the principal or face value here is $100,000, which means they're going to issue 100 $1,000 denomination bonds. That totals $100,000 in all. If the bonds are sold for face value, because the stated interest rate matches the market interest rate, then the amount of cash the company is going to receive is exactly going to match the amount of the bonds payable that are issued. And here's our journal entry for the first interest payment. We would multiply the principal or face value times the stated rate, and since this is annual interest, we'd multiply by 12/12. We would credit cash to make the payment to the bondholders and debit interest expense. Oh, one more thing I forgot to mention. When the market rate of interest and the stated rate of interest are the same, when they match, then I had just said that the bond would be sold at face value. The issue price would match the amount of the principal or face value. That issue price in the newspaper or wherever you get your bond quotes would be 100, which means it's selling at 100% of face value or par. In fact, the way we calculate the amount of cash we're going to receive is we multiply that 100 and put a percent by it times the face value, and that tells us how much we're going to get in cash. So when the stated rate, the rate of interest that the bond is paying, matches the market rate, the issue price is 100, we multiply the face value times the 100%, and that gives us the amount of cash that we'll receive. Let's do a problem. We're going to be doing 10-7, E10-7.
Okay, I've scrolled in a little bit here. This problem is similar to M10-11, which you might be seeing on your homework. It says, on January 1st, Applied Technologies Corporation issued $500,000 in bonds that mature in 10 years. The bonds have a stated interest rate of 10%. When the bonds were issued, the market interest rate was 10%. The bonds pay interest once per year on December 31st. So the $500,000 is considered your face value. The bond interest rate or stated rate, that's the amount that we use to calculate bond interest payments. And when the bonds were issued, the market interest rate was also 10%. Because these two rates match, the bonds will sell at face value or par. The bond quote or selling price would be 100 in your financial publications or online. So how much would ATC receive? We're going to take the face value, 500,000, multiply by 100 with a percent next to it, and that gives us $500,000. So on January 1st, we will debit the cash account for the $500,000 we just calculated, and we will credit bonds payable, also for $500,000. Bonds payable is always credited for face value. In fact, I'll write that down here. Face value. That's the amount that has to be paid at maturity, so that's the amount the payable should be recorded for. Now let's calculate the annual interest expense. We'll be debiting interest expense, and since we're paying it out, we'll be crediting cash. The calculation is the principal, the P, of $500,000 times the annual interest rate, 10%, and the time factor is a full year, so that's 12/12, or the number 1. And that gives us interest expense of $50,000. And that ends our example. You can go on to the next mini lecture.